And UBS shares are hitting a 17-year high after a group of influential Swiss lawmakers proposed watering down the capital requirements for the bank. The proposal would allow UBS to use junior debt, so-called AT1 bonds, instead of equity to meet the capital requirements. And to talk about this, I want to bring in our chief Wall Street correspondent, Sridhar Natarajan, joining me over here at the desk. Sri, this is an important story on so many levels, especially for our viewers and clients. But first of all, it means UBS probably won't move to New York, right?
So the lesson from that is perhaps playing hardball works. And we should remind our listeners and viewers as to why we're even talking about UBS in New York. Not that it has ever been floated as a serious proposal, but in the last few weeks and months, there has been a lot of murmurs and rumors and talks about UBS, senior ranking UBS executives talking to US officials, potentially relocating their headquarters out of Switzerland, which would be a big hit for Switzerland because UBS is the last remaining globally significant bank in the country, a country that is built on its banking system. What we have today is a group of influential Swiss lawmakers trying to find a compromise. And the details, there are some details here, but the details at this stage truly are not relevant because these will still be debated a year and a half down the line. We're talking about debates in 2027. But the idea is to make sure that they get to the negotiating table because up until now, the Swiss government was taking a very hardline stance, which would have meant that UBS would have had to set aside $26 billion in additional capital to meet their demands for a safer banking system. And UBS had been saying that would simply not be acceptable because it would make them uncompetitive.
By the way, UBS shares apparently rise to a 17-year high, and they have returned, well, they've tripled in the past 5 years, but they're not doing as well as Goldman Sachs over that period, not doing as well as Deutsche Bank over that period, not doing as well as HSBC, and I haven't even looked at the Spanish banks, which are killing it. What's going on with this insane bank rally, like all across the globe?
Well, what's happened this year is we've finally seen a big return in deal-making activity. You've seen that even as this has happened and people are worried about where the economy is headed, could there be a turn in the economy? When you look at the actual underlying numbers right now, the biggest banks are not that concerned. They're talking about a resilient economy. Their consumer banking operations are doing fine. And when you talk about the investment banking side of things, when you have so many deals in the pipelines, major deals, there is a flow-through effect into other parts of that investment banking business. It's not just fees from advising on the biggest deals. It's raising debts, it's issuing equity. And there is also obvious trading activity that you will get from all of this business that the investment bankers are bringing in. So right now, it is a good time to be a major bank that is globally significant.
Especially in Spain. I just looked up Santander. In the same period, over 5 years, they've returned with reinvested dividends, 353%. Is there a bubble in bank stocks? Are we worried about the wrong bubble here?
Wow, we're now trying to find bubbles everywhere. Look, when you think about what has happened in some of the more exuberant parts of the market, it is very hard to look at the banking sector and talk about bubbles. And let's bring back the conversation to why we're even talking about the banks today. It's the strict capital demands. And there is this sense that in the last 15 years, regulators have acted in a way that has made the banking system safer. And that's why in the last year or two, more of the conversation is about what is happening in the non-banking system. And are there enough eyes on it? And are there enough guardrails placed out there? So not saying that nothing could possibly go wrong with banks, but on the surface, there's no obvious sign that banks are in some sort of bubble territory.
I just put a smattering of the big ones here, and you can see JP Morgan is the worst performer among all of these big banks. If you can decipher the tickers, those are UBS, JP Morgan, Goldman Sachs, Deutsche Bank, HSBC, and Santander. Sri, great talking to you.